the constraints of which are involved in the construction of a portfolio. We also looked at the circumstances, or rather or the objectives, the risk objectives of the investor, and also the return objectives. We said you have different types of risk persons. You have risk lovers, people who love risk. They call risk lovers. There are people who are neutral, and there are people who avoid or rather they call risk averse. They avoid risk in their transactions or in their investment undertakings. And we say that as a portfolio manager, one of the key issues, or rather one of the components that he or she is concerned about, is the risk objectives and the return objective of the investment. The project that he or she is going to undertake, he must do what we call risk analysis of that project. After that, again, he must look at the returns that the project is going to generate. So in our today's lecture, so you are going to make an introduction to risk and return. We want to look at different ways or different measures of return and different measures of risk. And in return, we have different formulas that we are going to use to calculate the return of a single. It could be of a single, it could be a return of a single project or a number of 2 or more projects. So 2 or more projects. Their returns. At the same time, we are going to look at the risk involved in a single project, or even more, 2 or more projects. We find that most companies or most firms, they do what we call diversification of their projects, so that they may have different investment projects. They can invest in a riskier project. At the same time, they can invest in a low risk or a less riskier project. The reason of doing that is just in case this one does not pay off, the other returns offsets the losses made in the other projects. So we are going to look at that, the risks which are involved in different projects, and on the measures which are involved in the risk and the return calculations. So you find that financial assets, they normally generate 2 types of returns. First, we have the periodic return. So financial assets, they generate 2 types of returns. First, we have what we call the periodic returns. These we may have returns such as dividends, which are periodic. They could be periodic, means it could be once in a year, it could be annually, then annually, quarterly, or even monthly returns. At the same time, we have what we call interest payments. Interest payments is also an example of a periodic return. Interest payments can be, you can pay interest in a monthly basis or in annually basis. Even semi-annual, we have returns which are payable in a monthly basis, same annually twice in a year, quarterly, and also annually once in a year. So also you have the second type of returns that financial assets may generate. which can increase is called the capital gain or loss. So we have the capital gains. Stroke losses. It could be a capital gain, a capital loss. So first of all these returns, they can be measured. So before you engage in an investment, you can do a periodic, you can do a predetermined calculations just to see where or if the returns will be there in that project, or if it's not a viable project, you can do away with it. So we have number one of the ways that we can, or one of the types of returns we have is holding. What we call holding period return. So number one, we have holding period return. So holding period return, it can be measured over a single period or multiple periods. So this is where you can measure it in a single stroke multiple periods. Remember, we said that we have periodic returns. Holding period return is the return earned from holding an asset for a single specified period of time. So holding period returns is a return which is earned from holding a single or an asset for a single specified period of time. So holding an asset for a single specified time. It could be 1 year, 1 month, 2 years, more. So for example, if the stock is bought now at a price of 100 and the same stock is sold late at a price of 105 shillings with no dividends, then the holding period return is 5. You take, so you have a formula of calculating the holding period return. We have said that a stock is bought now at 100 and later it's sold at 105. So we are asked to calculate the holding period return. So the holding period return, we calculate it by using this formula. The return is equals to this is the formula where P is the price which you are going to sell the stock. This is the price which you put the stock. This is the dividends if N, and this is also the price at which you bought the stock. So like in our scenario here in this example, we are told that a stock was bought at 100 and it was sold at 105. So you are asked to calculate the holding period return. So we substitute the elements here. It's 105, which is the price at which you sold the stock. You subtract the price at which you bought the stock, which is 100. Then we don't have a dividend in this scenario. Then you divide by the price at which we bought no, yeah, he bought the stock which is 100. So you find it's 0.05. Now you find that mostly the returns are denoted in terms of percentage. So you change or you convert this into a percentage by multiplying it by 100, and the answer is 5% return. 5% return. So this is the formula of calculating the holding period return, and you have seen that holding period return, this simply implies the earnings or the returns earned from an asset for a single specified period. It could be 1 year or 2 years. And then we have what we call arithmetic in return. So for example, before we look at arithmetic mean return, for example, we find that it could be, the holding period could be more than 1 year. If it's more than 1 year, then you could compute a 3-year holding period return as given by this formula. The formula could be of calculating a holding period of more than 1 year. So the return would be equals to 1 minus times 1 minus return 2 times 1 plus return 3 times so in case it's you are asked to calculate a return of a 3-year holding period, you use this formula. This here, the first component here, R1, is the return of the first year. This is the return of the second year. And this is the return of the third year. Now if it was a 4-year holding period of return, then it could be 1 again here plus R4. You continue substituting the elements that you have. So here, first of all, you must look for the return of the first year, the second year, the third year, and then you substitute in this formula and you find the return in that specified period of time. So number 2, arithmetic or mean return of arithmetic stroke mean return. So the arithmetic mean return is used to calculate the return in a period, and you divide that by the total number of periods. It's denoted by this, and the formula of calculating the arithmetic mean return is I is equals to the first return of the first year, you add the return of the second year, then you add the return of the third year, then you divide it by t, where t is the number of the period. Also, this is equal to 1 over t summation of the number of periods and the returns of those periods. For example, so the simplest way to compute the return is to take the simple average of all holding period returns. For example, you have a mean return, you're given a mean return of 50%. Example, you have minus 50% as a return of our investment. Then you have a return of 35% as an investment. Again, we have a return of 27. And then you are asked, can you calculate the arithmetic or the mean return of this kind of a portfolio? Then what you do, you take these mean returns. This for the first year, the second return, and this is the third return. So you substitute in the formula. That is now the solution is equals to minus 50%. You add that 5%. You add 27%, and then you divide by t, where we said t is the number of periods. Now here it's 3, divide by 3. By doing this, you find that you have approximately a 4% return. And then another number 3, you want to look another measure of return, and this is where we have the periodic returns. Number 1, we said we have the holding period return, arithmetic mean return. And now we have number 3 here, what we call geometric mean return. Geometric mean return. Now, a geometric mean return, this is where, or rather, it assumes that the investment amount is not reset at the beginning of each year, and in fact, account for the compounding of the returns, or rather, it affects the accounts of the compounding of returns. So the geometric mean return reflects a buy and hold strategy, whereas arithmetic reflects a constant dollar investment at the beginning of each time period. So here, the initial investment is not reset at the beginning of each year. So here you find that there's a strategy which is called buy and hold. You know, you have different types of investing strategies. They have the buy, we have buy low, sell high. It could be sell high, buy at low. You have another one which is sell high, then buy low. You have all these strategies that are investment strategies. But in the geometric mean return, now we are looking at where an investor buys and holds the investment, whereas in the arithmetic mean return, there's a constant dollar investment at the beginning of each year. So the geometric mean return is given by, is equals to 1 plus return, the first return, you multiply by 1 plus the second return, then you multiply by 1 plus the third return, you multiply by, and you multiply by 1 plus tan t Then all these you subtract by 1. Let me write it here so that you can fit here comfortably to avoid confusions. Is it geometric in return is given by, find the square root, 1 plus first return to multiply by 1 plus second return multiplied by 1 plus you multiplied by minus 1. 1 is outside the square root. The 1 is outside the square root. For example, if you have been given these returns, the 50% return minus 50%, we have that 5% return and 27% return. And they are asked to calculate the geometric mean return of that kind of investment. Then what you do, you key in, if you can work out this example is by 50%, it's a first return. So it's 1 plus minus 0.5 times 1 plus 0.35 times 1 plus 0.27. So this is 0.5. You multiply by 1.35. You multiply by 1.27 minus 1. You work out the components inside the square root. Remember our array here, it's 3 because we have 3 returns. So the cube root of, by 0.5, you multiply by 1.35, you multiply by 1.27, you get it 0.85725 minus 1. The cube root of 0.85725, it is 0.94995 minus 1. You find it is minus 0.05. So this is equivalent to minus 5%. So it is a return of a negative return of minus 5%, meaning it's not a good impression, or rather it's not a good venture. We have another return which we call the money weighted return. Money weighted return is our fourth measures of return. Internal rate of return. It's also referred to as the internal rate of return. So the money weighted return accounts for the money invested, the money weighted return accounts for the money invested and provides the investor with information on the return and on the actual investment. So the calculation of the money weighted return are similar to the calculation which are made in the internal rate of return. And the amount invested are cash flows from the investor's perspective amounts, and there is withdraw all the money that remains at the end of the investment cycle in the cash flows of the investment. So for example, we use the actual, an example of money with the return is, we use the actual returns from our previous example, and then assume that the investor invests $100 in a mutual fund at the beginning of the first year. So an investor invests, so initial outlay is $100 in a mutual fund, and then you are told that this is the initial outlay or the initial investment in a mutual fund at the beginning of the first year, and then he adds another 950 at the beginning of the second year. So this is the first year. Now, the beginning of the second year, he adds an additional of 950 in the same mutual fund. At the same time, he withdraws 350 at the end of the second year. This is the beginning of the second year where he made an additional investment of 950 in the mutual fund. At the end of the second year, made a withdraw, a withdraw of 350 from the mutual fund. So you are asked to calculate the money with the return. But first of all, before you do that, we must come up with a cash flows of this kind of investment in the mutual fund. So our cash flow is going to look like this. We have an year. So this is the part of the solution. So we have year. Then we will have the details, and then we have the first year, second, and third. So the balance from the previous investment, we have said that he made the previous investment that his investor made in was 1,000 in the mutual fund is 0. So you find that in the previous, so the balance rolled down from the previous year. In the first year, it was 0, because this is the first time he's doing this investment in this mutual fund. So this is the balance rolled down from the previous year. Previous year. The first year, it will be 0, because this is the first time he's making an investment in this mutual fund. And then there's a cash inflow to the mutual fund, the cash inflow. So cash inflow. And we are told that he made an initial outlay of 100. 100, not 1,000. Sorry. It's 100. So the initial cash flow in the beginning of the first year, it will be 100. When we have been given the question. And so you must look for the new balance as the beginning of the year. Since he made this at the beginning of the year, an initial outlay of 100. So the balance in the beginning of the first year itakuwa 100 because this is what he has in his account in that mutual fund. It will be 100. And then now we have been given that we are going to use the investment returns of the previous examples we used. So these returns were 50% returns. So here you have the returns minus 50%, you have 35% and 27%. This is the first year and the third year. So in this first year is going to make a return of minus 50%. So investment return in the first year, we have told is minus 50%. Minus 50%. Then let's look at the investment gain or loss. So if he's going to have a return of 50% and he had made an initial investment of this, so this is a loss, not a gain. So you have investment gain or loss. You have investment gain stroke loss, but now is a minus 50% return. So you calculate the investment gain, you multiply by the return by the initial outlay, you find it's 50. And it's a loss. You have made a loss of 50%, which is a bit in brackets, denote is a loss. So meaning that by the end of this first year, this person in his own account, he could have remained with $50 because he had an initial investment of 100. So $50. So let us put another row column here called there is withdraw. By investor. But in this first year, there was no withdrawal made. And then we had another year where it was the balance at the end of the year. At the end of year. So here is dash. So you find the balance at the end of the year, you subtract the initial cash inflow and the loss or the profit made. So it's fine is 50. So when you are calculating the we move to the second year, this 50 will be the balance of the previous year. So here it will be 50. And then the cash inflow, we are told that from our question that in the second year, he added another $950. So the cash inflow, it is 950 for the second year. So you find that the balance at the beginning of the second year, it will be an addition of the balance from the previous year and the amount that he has added or an inflow of amount in the second year, which was 950, you find it's 1,000. And then if investment return we were given, it was the 35% we are using of the second year. So it's 35%. So 35% of 1,000, which is the balance beginning of the second year, we find is 350. Now, in this scenario, 350 is again not a loss because he had made a profit, or the investment will give him a return of 35%. Again, you are told that in the same year, he made a withdrawal of 350. So it is 350. So with it, again, there was a withdrawal of 350. So this is subtract from the cash flow. So by the balance that at the end of the year will always also remain to be 1,000. To be 1,000. And then In the second year or in the third year, there was no additional input to the mutual fund by the investor. Neither was there a withdrawal of any amount of money from the fund. So the balance of the previous year would be 1,000. Cash inflow did not make any additional contributions to the fund. The balance of the beginning of the third year will be 1,000. And the investment return, we are told from the returns we had here previously is 27%. So it's a 27% return. When you calculate it, you find it is in terms of amount is $270. Again, this year, the investor did not withdraw any amount of money from the fund. So there was no withdrawal. And then the balance at the end of the year, we add the initial investment or the balance at the beginning of the year plus the gain or the return in that specific year, which is 270. You find it's $1,270. So this is our cash flows. So from here, now we can use these cash flows to calculate our money with the return or our internal rate of return. So we use this formula, summation of CF is the cash flows time 1 plus internal rate of return. Then you raise by T, which is the number of years equal to 0. So our first year return, we are told is, no, our first year cash flow is 50. First of all, there was the cash inflow, which was 100. The first initial amount of money that the investor had invested in the business. And the second cash flow is 950. Again, this is another amount of money that the investor invested in the second year, the additional in the second year. In the third year, we had a return, we had a return of 350, so that's another cash flow. And lastly, we had a cash flow of 270. But again, now, because this is the last holding period, we are going to use the entire period, which is 1,270. So cash flows one, actually from the initial one is 100. The cash flow is 950. So it was money that the investor invested in the mutual fund. In other words, he gave out money. And then there was another cash flow of 350 from the gain. And then there was another, the final one, which is 107, is an addition of the initial and the capital gain, because this is the last holding period of that year. So we equate this into a return. We are in the internal rate of return is a discount rate at which the sum of the present values of these cash flows will be equal to 0. And it's usually given, or you can calculate them. It has several ways to calculate that internal rate of return. So from here, we do our first cash. It is our first cash flow. We said it's minus 100. over 1 plus C F1 1 plus internal rate of return, which we are calculating now, plus C F2 1 plus C F3 1 plus square internal rate of return, you raise it to power 3, then you pitch this to 0. So this is our first cash flow. We say it's minus 100 divided by 1 plus R plus another cash flow is 950. 1 plus R, you raise it to 1. Another cash flow is 350. 1 plus R, you raise it to power 2, plus another cash flow is 127. 1 plus R, you raise it to power 3, then you pay this to 0. Then after that, you find your answer as 26.11% return. So this kind of an investment is going to give you a return of 26.11% return. So now let us look at portfolio return. Portfolio return. Portfolio return. Portfolio return. So we find that when several individual assets are combined into a portfolio, we can compute the portfolio return as a weighted average of the returns in the portfolio. The portfolio return is simply a weighted average of returns of the individual investment or assets. If the asset X, for example, has a return of 20% and it constitutes 25% of the portfolio. It's that a portfolio, it can comprise different projects now or different investment opportunities, even different assets. Now you say that an asset X has a return of 20%. Again, the same asset comprises or it constitutes to 25% of the total portfolio. This is the percentage, or you can it constitutes to 25% of the portfolio. Again, so you can calculate the return of this asset by, so the return of the asset is equals to the return which were given times the percentage it constitutes. The percentage it constitutes, which is 20% by 25%, which is equivalent to 5%. Now, what if in this portfolio we had another asset, name it Y, which we had another, for example, another asset, say asset Y, it's a return of, let's say, 30%. So asset Y as a return of 20, say 30%, and it constitutes to 75% of the portfolio, constitutes to 75% of the portfolio. Then you are asked to calculate the return of asset Y. It will be 50% you multiply by 75%. It will be 35% you multiply by 75%. Now, if now you are not looking at the returns of a single asset in a portfolio, and you are asked to find the returns of the whole portfolio, because these assets, asset X and Y, they are in a single portfolio. Now you are asked to find the return portfolio. What do you do? A return of a portfolio is calculated. It could be of more than two or two returns. It could be calculated like this, as the portfolio return, which is denoted by RP, is equals to WA1 plus W2 L2, where W1 is the weight of the first asset. The weight is what it constitutes in that portfolio. Like in X, it's 25%. The return is the return of that specific asset in that portfolio. And in the first asset, for example, is 20% return. You add now, which we found is 5%. You add this into the weight of the second asset, which is our Y, and it constitutes 75% of the total portfolio. You multiply it with the return of that asset Y, which is 30% return. You find the return of a portfolio. So this is the formula of calculating the return of a portfolio for two assets in that portfolio. Again, remember, it could be more than two assets, well, three assets. Then you could add plus, if it's a return of 3, it equals first weight, first return, you add the second weight, the second return, plus the third weight, multiply with the plus, and you continue that way. In case there are more than two assets in that return. So because for example, where the returns, the assets are two in this kind of a portfolio, find that the weights or what it constitutes in the portfolio, they should always be equivalent to 100. That's why you have a 25% return, a 75% return. When you add 75 to 25, you find is 100%. So where there are two assets in a portfolio, their weights must always add up to 100%. So you find that the first weight plus the second weight will give you 1, that's 100%. And we can reshape the formula to this. We have said that where the first return or the first weight, where the portfolio consists of two assets, as it could be X and Y, their weights should always add up to 100%. And we have said that if it is the first weight plus the second weight is equals to 100%, which is equivalent to 1. So W1, the first weight of the first asset, plus W2, the second weight of the second asset, should give you 1. So from here, we can write that the second weight, W2, it could be equivalent to 1 minus W1. It would be 1 minus the weight of the first asset. So by substituting these into this formula, we said it's the return on portfolio equals W1 return 1 plus W2 return 2. Now, if you can substitute this formula, this element here, we say that W2 is equals to 1 minus W1. Into this formula, you will find that the return on portfolio is equals to W1 plus 1 minus W1, you multiply by the return of the second portfolio. By the second portfolio. So an example is given by whereby we have an investment where, say, asset X and asset, say, asset A and B, the return, and we have the weights. Sorry. There are the returns and the weights. With asset 1 gives you a return of 30%, and it constitutes to, let's say, 50% of the total portfolio. Again, asset B has a return of 40%, and it constitutes also to 50%. So you are asked to calculate the return on portfolio. So if you calculate the return on portfolio is equals to, use this formula, the first return or the first way is 50%, so it's 50%. You multiply it by the first return, which is 30%. You add the second weight, which is 50%, and the second return of the second asset or asset B, which is 40%. The second return of which is 50%. After doing that, then you say that the return on portfolio is equals to 50%, this will be equal to 0.5, you multiply by 0.3 by 0.15, 0.15 plus this is 0.2, and it gives you a portfolio return of 0.35, which is equivalent to that 5%. This is the portfolio return of this portfolio, where we had assets A and B with these returns and weights. So these are the measures that we use to calculate the portfolio returns, or even a return of a single investment held in a single period or a specified period. Now let us look at the return. No, let us look at the measures of risk in an investment or in a portfolio. Measures of risk. Measures of risk. Measures of risk. So the first measure we have is variance and convergence of returns. So we have variance, first measure of risk. And so these are measures of risk, or the measures of riskiness of those returns that we have been calculating. Find that the total risk of an asset or portfolio of assets is measured by its standard deviation, which is the square root of the variance. So the first risk of an asset or a portfolio of assets, it's measured by use of standard deviation. And we know standard deviation is a square root of variance. So variance is a measure of the volatility or dispersion of returns. So variance is the measure of volatility of returns. Or the dispersion of returns. So variance is measured as the average squared deviation from the mean. So this is measured as a squared deviation from the mean. So the higher the variance is, that the returns are less predictable, and therefore they are more, it's a more risky investment, or the asset is more risky. So the higher the variance, it shows that assets or the investment is not cannot be predicted, and it's a risky investment. It's a risky investment. So the variance of the returns is equals to, and we denote variance by delta squared. So variance, which we denote by delta squared, is is equals to the summation mu. This letter A is a Greek letter which stands for mu. Write it. It's a Greek letter which stands for me. It means the mean. You square this, and then you divide it by t, the time. So this returns for the period which you are given. T is the total number of periods, and mu is the mean of total returns, assuming T is the population of the returns. So by doing this, you find the variance. But now you are interested with the standard deviation, because we say that risk of an asset or a portfolio of assets is measured by use of standard deviation. But again, we say that variance is a square, it's a square deviation of the mean. That's why you have here there's mean, and the deviation, that's why you have the return minus the mean. So for us, in order for us to find the standard deviation, because this is a square of the standard deviation, then we find the square root of this variance. So now the square root of the variance gives us the standard deviation. Standard deviation now, by finding the standard deviation, now we could take the risk, or we have the risk of that portfolio assets or the asset itself. So the standard deviation, it could be equal to, after you square, or you find the square root of this square, it could be equal to summation T is equals to 1 to T then you square this divided by T. All these you find their square root. All that you find the square root. So standard deviation is the measure of the risk of an asset, which may also be referred as volatility. We use the standard deviation to measure the volatility of the returns of an asset or a portfolio of assets, and we find it by finding the square root of the variance. By finding out the square root of the variance, this is now when you are given a population. Now, what if it was a sample? From a sample, standard deviation would be the square root. This is where is a sample of returns. It's not, there are no specified period of time. So this summation of t from 1 to t, the return of that period. We subtract the returns. This is where it's a mean return. Then you square this. Then you divide it by t minus 1. This is where it's a sample. And here is where you are given a population of returns, population of returns, population of returns. Then that other formula is applicable where you are given a sample of returns. So when computing the variance of a portfolio or portfolio returns, standard statistical methodological can be used by finding the variance of the full expression of portfolio return. And also the variance can be expressed more generally for it for n securities in a portfolio using the notation which you have just said. So if you are looking for, now this is when you are finding a return on probably of an asset. And what if is a portfolio of assets and you have been asked to find out the return of portfolio assets. So the return of portfolio assets, not the risk of portfolio assets, which is the risk of portfolio assets is equivalent to the variance of that portfolio, which is equivalent to the variance is equals to 1 to n, the first return number of assets that you are given, number of assets that are given. So a formula that is used to calculate the risk or the standard deviation, the covariance of a portfolio return, it could be written to this. It could be written to square is equals to W1 A1 squared plus W2 is the second weight of the second asset. Then you add 2 W1 and W2, the covariance of return 1 and return 2 and 2. They can also be written to is equals to the first weight squared, the second risk squared plus the first, second, then you add 2 W, the first weight, then second weight, then we have this 1, 2, first risk of the first asset and the risk of the second asset. Now, again, this is a Greek word. It represents the coefficient of correlation. The coefficient of correlation. So the standard deviation of a 2-asset portfolio, the standard deviation of a 2-assets portfolio is given by, so now it's the square root of these two, either of this formula. So the first is, when you find the square root, you find it's equals to the square root of the first expression, which is W1 squared del 1 squared plus W2 squared del 2 squared plus 2 W1, W2, W represents weight and delta is representing the risk or the standard deviation of the first and second assets correspondingly or respectively. Then it is the covariance of first and the second return, or can be expressed in the second expression, which is equals to find the square root of weight 1 squared and division of 1 squared 1 squared standard deviation 1 squared. Then you add weight squared, then you add to the first weight, second weight, then that coefficient of relation 1, 2 of the first, the correlation between the first and the second asset, find their risk. So these two formulas can give you the standard deviation of portfolio management. They could both give you the standard deviation of a portfolio management. So let us look at one example. An example of return risk of two asset portfolios. Let's look at one example, and then we also look at other past questions from the past papers, and we try to answer them. So assume that an investor, you as an investor, you decide to own a portfolio with 80% invested in the Standard and Poor 500 stock. So you have a portfolio with 80% invested in poor. This is a stock exchange company. And the remaining 20% you invested in an emerging market index. So 20% you invested in index. The expected return is 9.98 or 93 for the stock. So you have 9.93% return of the S&P stock. So this is 80% as a return of 9.93 return, and 18.2% for the index. And then you have a return of 18.20% of the index. This is another return in the index. And then again, you are given that the risk or the standard deviation of the first asset is 16.21%. So you are given that the risk or standard deviation now S&P, so the Standard and Poor, has a risk of 16.21%, and in the index has a risk of 33.11%. So for the emerging market index, there is a risk of 33.11%. So you are asked, what will be the portfolio's expected return and the risk given that the covariance between the S&P 500 stock and the emerging market index is 0.5. Again, you have been provided with the covariance between the two assets, that is the emerging market index and the S&P 500 stock. So the covariance given is 0.5. And you are asked to calculate 0.5%. You are asked to calculate now you are required you calculate the portfolio, calculate the portfolio expected return, and calculate also the portfolio risk, so return and the expected risk. Calculate the portfolio return and the expected risk. So let us look at the solution. The solution of this question. So first of all, we are asked you to calculate the expected return, or rather the expected portfolio return. And we say that the portfolio return, is equals to the first weight you multiply by the first return of that asset, you add the second weight and you multiply it by the second return of the second asset. In this scenario, you have only two assets. You have two assets and their weight adds up to 100 because it's 80% and 20%. So our weighted return, our portfolio return will be equal to the first weight, 80%. The return of S&P stock, which is 9.93%, 9.93%. Then you add the weight of the second asset, which is emerging market index, which is 20%. So 20%, you multiply by the return, which is 18.20% times 18.20%. And then now here we find the return on portfolio is equals to 11.58%. Sorry, equals to 11.58%. So this is the return on the portfolio. And so another question is calculate the risk of the portfolio. And we say that the portfolio risk, portfolio risk is equals to the square root of the first weight squared, you multiply by the risk of the first asset squared, you add the second weight squared, multiplied by the risk of the standard deviation of the first, then you add 2 multiplied by the first weight, second weight, and then you multiply it with the covariance of the first and the second return. So from here, we have everything that we need to substitute into this formula, because they gave us a covariance of 0.5%. So this is this is the first weight of the stock market, W1. Delta 1 is the standard deviation of, again, the first or the USA stock. The same W2 is the weight of the second asset, which is the stock, emerging market stock, and it is risk. And the covariance, we have it at 0.5%. So we substitute the data we have in the formula, and we say that the return or the risk standard deviation of the portfolio will be equivalent to the square root of, so it is the first weight, it is 80%, that is equivalent to 0.8 squared. You multiplied it by the first, or the risk, which is associated with the USA stock, which is S&P 500. The risk is 16.21%, that is 0.1621 squared. And then we add it to 0.2, which is the weight of the second asset, which is the emerging markets asset. So it's 0.2 squared. You multiply it by the standard deviation or the risk associated with the index, which is 33.11%. So times 0.331%. Then you add 2, you multiply it with the first and second weight, which is 80%, and is 20%, which is 0.8 times 0.8 times 0.2. And then you have given the covariance between the USA stock and the emerging market index at 0.5%. Again, you add or you multiply it here, so it is 0 times 0.005, or these you find their square root in order for you to find the standard deviation. So after substituting these, you find that your standard deviation will be equivalent to the square root when you do or you work out the first segment, you find it 0.01682. You add, you find the second segment yields 0.00439. and the third segment will give 0.0016. You add the components, you find that is 0.02281. Find the square root so that you can find the standard deviation, and the standard deviation will be equivalent to 0.15103, which is equivalent to 15.10%. So this is the portfolio return and portfolio risk associated with this portfolio of S&P 500 USA stock, and another asset which is an investment in the emerging market index. So you find that the portfolio expected return is 11.58 and the risk is 15.10. But again, a very interesting thing is that you find that this emerging market index has a return of 18.20 compared to the return of the stock, which is 9.98, almost twice. But again, you find that it has an higher risk, a risk of 33.13, again, which is twice as the risk of USA stock. Now, a combination of these two brings up a risk of 15%. But again, you find that the allocation in that portfolio structure, the element or the asset which is very risky, which is this, it's a risky investment. It has been allocated, or it constitutes to a small percentage of that portfolio, which is 20%, and the investment which is not really that risky, it constitutes to the biggest percentage of the portfolio, which is 80%. Now, this balancing is done after you have done these calculations. You see that you don't have to invest a lot of your money in a riskier venture. Rather, you could invest it in where the returns are more secure compared to the where it's very risky. So the example shows that we can take a portfolio of USA investor invested only in the S&P USA stock. You combine it with the riskier portfolio, which consists of the emerging market index securities, and the return of the investor increases. So the return of the investor from who had the initial investment in the USA stock increases from 9.93% to 11.58%, while the risk of the portfolio actually falls from 16.21% to 15.10%. Not only now does the investor get a higher return, but he also gets it at a very lower risk. After combining all the having this kind of investment in his own portfolio, not only does he get the higher return, because the returns has increased from 9.93% to 11.58%. So there's an increase in the return. At the same time, the risk, which was 16.21, and a year after having a portfolio of adding at the portfolio the index of emerging markets, the risk reduced to 15.10. So the investor gets higher returns at a lower risk. Higher returns at a lower risk, but it's not always the same. Sometimes you get higher returns at a very higher risk. It's also possible. It is also very possible to get higher return and a very high risks. So in our next lecture or in our next lesson, we are going to look at the utility theory and the indifference curve and different types of risk persons. We said we have someone who loves risk, because a risk lover. We have another person whom we call a neutral. Another person, in terms of risk, we have what we call risk averse, a person who would always avoid risk at all cost. We look at them in our next. So we have a risk lover, neutral person, or a neutral investor, and a person who averse, risk averse, in our next lecture. Thank you very much.